if the media gets on board with the idea that there's a recession, my greatest fear is that it could become more self-fulfilling prophecy because so many Americans have been feeling recession for a
Right.
very long time now. But if the media all of a sudden jumps on board and agrees with them, then my greatest fear is that we'll entrench too much, that there will be too much of a pulling back because there's an underappreciation for how fragile the economy was to begin with.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Last year, fears of recession faded from the headlines as the no landing narrative won out. But the disruption brought by the new Trump administration, especially around global trade, has brought recession concerns back to the forefront. Now, the administration says it's not worried, that we're merely passing through a transitory detox period before new trade deals, tax cuts, and deregulation kick in to turbocharge economic growth. But others fear a more pronounced slowdown is in the cards. So, which outlook is more likely? To find out, we've got the good fortune to speak today with Danielle DiMartino Booth, CEO and Chief Strategist for QI Research and author of the book Fed Up, an insider's take on why the Federal Reserve is bad for America. Danielle, thanks so much for joining us today.
And thank you for having me. It's great to see you again, Adam.
Thank you. All right, Danielle, look, it's actually been a while since I've kicked one of these interviews off with the general question that I want to, which is what's your current assessment of the global economy and financial markets? Feel free to start with that if you like, but before we turn the camera on here, you brought up an interesting concept where you're sort of seeing America at kind of a hand the baton off moment, and you've got a strong sense of where the baton is being handed off from, but maybe we've got a much less clear picture on who's going to be taking that baton next. So maybe why don't we start there?
So, Adam, the current background, I suppose the higher the sense of uncertainty grew, the more I kind of started looking into history to try and get my bearings.
Hmm.
And in doing so, I had an epiphany uh, because I started looking at waves of the stimulus measures that have helped support the mighty US consumer, right? 70% of US consumption, sorry, 70% of US GDP, 18% of global GDP, that is the US consumer. And it got me to thinking, when was the last time really nobody was looking after the US consumer? And to answer that great big question, I had to go back to the era when Paul Volcker was at the Fed, which takes you quite a ways back,
Okay, yeah.
nearly 30
So
years.
we're talking, yeah, 30, 40 years actually, right?
So yeah, 87, yeah. So in the era that followed the maestro, if you will, whose PhD dissertation was on housing bubbles, which he asked to be removed from the NYU library the day he was confirmed by the US Senate to be chair of the Fed. Uh, there are ironies in this world, and then there are ironies. But a lot of the work that he had done on housing earlier on in his career was based on something called mortgage equity withdrawal. And in the years that followed Greenspan's coming to office, mortgage equity withdrawal came to be 9–10% of disposable personal income. So a big number, a huge support for personal consumption expenditures. And so we know that that fell off in the aftermath of the first housing bubble bursting. But if you look at borrowing in America, something actually replaced it. And so by the time you got to from kind of 2006 up until 2018, when it peaked, student loan borrowing grew to be 9% of disposable personal income.
Wow.
Wow, that's a big number. And so it peaked out as a percentage and has been falling off in the years that have followed, leading in its wake $1.77 trillion in debt. So what followed that? Well, that was the pandemic baton handoff. And so, well, what did that look like? Well, that looked like the FHA becoming everybody's mortgage lender. Right now, they've got an average debt to income ratio of 64%, more than double what it was when this adventure began. And in addition to that, $15 trillion of federal spending, along with people taking out mortgages for the first time, people taking out car loans for the first time, people not having to pay their student loans for 5 whole years, and people piling on credit card debt and other personal loans and buy now, pay later, which we think will be about $250 billion by the end of this year. You start throwing around hundreds of billions and trillions of dollars, and at some point you're talking about real money. But what now? And I have asked the smartest people I know, but what now? Right now, we're contemplating the avoidance of a negative income shock. So we're trying to avoid a negative income shock by way of extending tax cuts that were enacted in 2017. So we're trying to avoid corporate America getting hit with a negative income shock. Well, okay, Adam, that's not a supplementary marginal form of stimulus. Nope, that's not it. We're looking at a negative income shock because Linda McMahon has told us to expect one. 20.5% of student loan borrowers haven't paid anything in the last 5 years or so. 9.7 million is what the New York Fed figures will be hit. Number of borrowers will be hit, have their FICO scores impaired by virtue of having to begin repaying these student loans. There's a lot of buyer's regret among millennials who bought homes. A lot of them are trying to list their homes for sale. The Airbnb bubble is bursting as we speak. A lot of those Airbnb jocks are trying to get out from underneath their mortgages. Redfin just reported that second home sales have declined to the lowest on record. Something tells me that grandma and grandpa are going to start looking hard at their stock holdings. They're going to start looking hard at all that residential real estate they're sitting on. Individuals the ages of 70 and older in the United States, the median age of a baby boomer, own 40% of the US stock market. They own 25% of residential real estate. And the only thing working in their benefit is Jerome Powell. And the fact that Jerome Powell has only taken away 100 basis points of their interest income that they've grown to rely on as much as they have. So as long as Jay Powell stops reducing interest rates, then the fixed income that they've grown accustomed to enjoying, living off what, 4.25% income on their cash, as long as that stays a steady state, then they're not going to be tempted to sell their stocks, and they're not going to be tempted to sell their second homes. But again, I'm asking myself a question. What is the marginal source of stimulus?
Mm-hmm.
And I don't have an answer to that question.
I think it's a really interesting question. And let me just make sure that I took notes here correctly. So you said marginal source of stimulus. Another way to say that just might be a boost to consumer spending from artificial interventions, right? So kind of from the Volcker era on, as you said, we made home equity really available. So people were able to use their homes as piggy banks. Student loans ballooned. Obviously, the trillions and trillions of stimulus that were issued during the pandemic. And then following that, the years of moratoria. So, hey, you don't have to pay your rent, your mortgage, your student loans, whatever, right? Now those are all ending, as you're saying. On the tax side, there's the specter of a negative income, income tax shock, or sorry, negative income shock if we didn't get the Trump 1 era tax cuts renewed, which looks like it'll happen, but no guarantees. The new administration kind of has a make lenders pay philosophy, right? Hey, sorry, everybody, you got a really good ride, but now you got to pay, especially, latest you said Linda McMahon on the student loans. The housing market is in correction. How much more that goes down. And as you said, one of the things that's been serving as a form of stimulus, at least to people who have assets, largely the boomer class, has been these higher interest rates where you can park your money in something relatively safe like a T-bill and get a nice 4+% yield. That could be ending, TBD, but Fed certainly is talking like it would like to cut. It has paused, but I think its plans are to hopefully resume cutting, and the market thinks it's going to resume cuts. So your big question is okay, so those things aren't going to help. So what is going to step in and fill this gap? So I guess I got a couple of questions for you. One, what does it look like if this gap doesn't get filled, right? And two, here's what I think the Trump administration's answer would be, which is, hey, Danielle, you're right. We might have a little bit of turbulence, in the near term as we try to construct our bridge across this gap. But we're going to solve this with economic growth, right? So taxes, yep, we're going to avoid that income shock, right? Because we're going to extend the initial Trump tax cuts, but then we're going to add additional tax cuts, right? No tax on overtime, no tax on tips, no tax on Social Security. I haven't really seen the box yet of how much more that would contribute in terms of money saved, but I'm
It's
sure it's
a
not
small
nothing.
box. Yes.
Yeah.
Yes.
But they would also say, hey, look, this whole everything we're doing here, all these trade deals, deregulation, et cetera, it's all about trying to stimulate domestic growth, right? And so we're going to have jobs come back to the country. And they're announcing all sorts of commitments, right, of companies, many foreign ones that are going to start manufacturing here. Trillions of committed capital. It hasn't necessarily shown up yet, so I'll till TBD. But I think they're going to say, hey, look, we're going to keep taxes low, get them even lower, maybe even get rid of the IRS and only have an external revenue service. And we're going to just have so many jobs here that wages are going to go up, and net, real wages, real household savings are going to go up over time, and that's how we're going to fill the gap. Is that possible, or is that too rosy?
I don't necessarily think that it's too rosy if you can stop the march of time. And
Which doesn't sound like an easy thing to do, but okay, let's see.
no, it doesn't. And the reason you would have to stop the march of time is because the one thing you're not stopping in its tracks is the anger element. And
Mhm.
so the individuals we're talking about here, I'm not talking about the baby boomers necessarily who own 40% of the stock market or 25% of residential real estate. But I'm talking about those who make between, call it $100,000 a year and $250,000 a year. And I don't throw these numbers out there willy-nilly. It's because I've studied them.
Mhm. And what would maybe call that cohort what's left of the American middle class?
Sure. And they're also Americans who did not qualify for student loan forgiveness when that was being handed away like candy. And also, they happen to be the ones who have the highest amounts of student debt that they'll have to repay. They got the college degrees that gave them the highest paying jobs, but they also took on an extraordinary amount of debt
Mhm.
in the process. And many of them were working under the assumption, and why wouldn't they, after 3 or 4 years of not having to pay them back, that they would never have to pay them back? And at the same time, they started replacing those obligations that they were not making with credit card debt, with BMWs, with auto loans, with mortgages that they certainly didn't have before the pandemic hit. Um, and then, their nasty employers were so rude as to say, come back to the office. And now we see in the Atlanta Fed wage growth tracker that job switchers year over year, their wage gains are 3.4% below that of job stayers who are making 3.5% year over year.
Hmm.
So quitting in any form doesn't help you, whereas quiet quitting used to get you a huge pay boost.
Right.
Now, quitting of any kind, quiet, noisy, or in between, you're going to make less than if you're somebody who is digging in and keeping their job and doing whatever it is that you need to do to keep your job because you see that your kids aren't getting jobs out of college. You see that their friends are struggling, and you see your colleagues in middle management and in white collar professions have lost their jobs. They're having a really hard time getting another one. So if you've got a job, you're working really hard at keeping it. And therefore, you're actually getting awarded a little bit, 3.5% year-over-year wage gains compared to 3.4% for job switchers. Just 2 years ago or so, those job switchers were making 9% year over year in wage gains, but those days are gone. And you have, in addition to the estimated 260,000 federal employees that have accepted buyouts in some form, I read just a few days ago. So they're on severance, which makes them a safe cohort until September. And but they're looking for jobs as well,
Hmm.
providing competition in the job market. And the private sector has continued month after month after month to shed 100,000 or more jobs. So we have a situation where I go back to saying to myself, what's next? Because if it is going to be bring jobs back home, we're going to have to do it so quickly that there's no damage done during the midterms. And
Okay.
that's about the beginning and the end of it.
All right. So I can totally see if that cohort of the population is becoming victim of a worsening jobs market, right? Rising unemployment rate heading into the midterms. That's bad for the current administration, right? Um, that doesn't necessarily need to correlate also to having a recession at that point in time, but I'm curious, reading the tea leaves now, and I know that you've said in some of the past times that I've interviewed you, you highly suspect that important parts of the economy have already sort of been in recession. But given your current market outlook, do you see the odds as more likely that the U.S. in fact enters visibly a recession where it's not something that wonky people like us are kind of debating, but it's sort of the average person is like, yeah, this is a recession. Like, what odds do you peg for that between now and the midterms?
Well, so the disparity between the soft survey data and the hard data is the widest on record. And that's not my opinion. Those are some graphs that Goldman Sachs put out just a few days ago.
Right. And let me just interject so you can include this in your answer. Now, when presented with that, Secretary Treasury Scott Bessent has said, I've been in the business for a long time, and soft data can tell you lots of things that don't necessarily materialize, and I'm only going to worry when the hard data starts to show it, and I'm not seeing it in the hard data. So, in your answer, just reflect your response to that type of outlook.
Well, so of course, when such statements are made, the thing to do is to go check the data. And what we find is that when anticipations of rising unemployment are acute with those who are college educated or highest income earning terciles,
Hmm.
that has a direct correlation to personal consumption expenditures on an inflation adjusted basis. And I mean direct, like 90% correlation. So, with deference to Besant, if you're looking at the aggregate number of individuals anticipating a rising unemployment rate, he's correct. It does not necessarily manifest as impaired consumption. But if you're looking at some of the lowest readings on record on the labor market among those who have college educations or more, namely because, oh, I don't know, they're the ones hiring and firing people.
Right.
They tend to be a little bit closer to what's actually going to happen in payrolls, then what their perceptions of the job market are very real and tangibly associated with personal consumption expenditures.
Okay, good point. So you don't have to have necessarily a college degree to run a business, but the closer you get to the C-suite, the more business, and become a business owner. A lot of those people tend to be more educated. So when that court or whatever echelon of the business community starts getting worried, it does correlate with future behavior change.
It does. It does indeed. And again, Goldman Sachs ran a chart that showed that in prior economic cycles, there is indeed a lag between the soft and the hard data.
Hmm.
But in the current situation, the disconnect between the two, it's nothing like anybody's ever seen. And that it is wonky, it is boring, but it's also relevant. It's relevant that in the second and third quarters of 2024, and when you add the regular monthly revisions that we've seen from the BLS, that in the year end at March 31, there were 41% fewer jobs created than what had been reported. That's a big number with only half the data in hand, right? We're talking about a year that ended just a few weeks ago, March 31, 2025. In a year that ended March 31, 2025, there were 41% fewer jobs created than what was originally announced, and we still are missing the fourth quarter of 24 and the first quarter of 25. And by the way, the lag time with getting that data is going to be further impaired because the Trump administration has reduced the budget for the Bureau of Labor Statistics. So now we won't find out until June 4th what that fourth quarter of 2024 looked like, and until I believe September the 5th, what that first quarter of 2025 looks like. But just based on downward momentum, if we've already lost 41% of what we thought we'd created, there's a very good probability that nothing is left by the time we get to that final revision. And that does matter because the layoffs have continued, and this was the starting off point for the layoffs on the federal side.
Okay. So if I can, let me try to peel back some of the layers here. So let's go back to last October. Okay. You could make, I think, pretty much the same argument of here were the, from the Volcker era, here are the things that have been goosing the economy artificially, right? I think you, and don't let me put this word in your mouth, but I think you and I would probably have said, that's not sustainable, right? Like that's not a way to permanently run an economy, right? You're nodding as I'm saying this, right? And so we probably could have had a pretty animated discussion about reforms that we would put in place if we were magically, anointed leader of America the next day. So now we've got the Trump administration, and they are implementing reforms. So I guess my question for you is how much of your current concern about what may be happening, in the next 12 months from here is from the sins of the past versus the disruption of the present?
I think it is a combination of the two because the starting point of the US economy was not as strong as what had been advertised prior to President Trump taking office. And therefore, it kind of parallels to the second half of 1980, when the United States had just gone through a very quick period of downturn and then come out of it. And Reagan gets to office, 1981. Jimmy Carter had seen an explosive growth in his 4 years in office of the federal workforce. Ronald Reagan comes in with his own, it wasn't Elon Musk's chainsaw, maybe it was Reagan's machete, but he took a machete to the federal workforce, and all of a sudden, boom, from a weak base, those federal layoffs ended up causing the double dip recession of 1981, which prior to the Great Recession of '07 to '09 was called the Great Recession. So I think that that's where I'm headed with this. It's that the economy was in a very fragile state, one that was unadvertised when Trump came. A negative shock was placed on top of this, which we don't feel right now because that severance doesn't run out until September for the federal employees. But on top of that, we've seen the private sector withstand a shock of its own with there are tariffs, there won't be tariffs, there will be another 90-day reprieve, there won't be. It's a lot of back and forth, and yet we're still seeing as a steady drumbeat in the background until the uncertainty dissipates. We're just going to continue to cut costs to shore up margins because we cannot pass our input costs, our higher input costs along to end consumers because they don't have purchasing power. So rather than sustain a margin squeeze, we're just going to continue cutting costs until we have certainty about whatever this policy is actually going to look like. If you wake up one day, Adam, and you're Joe Q CEO, and you see that there's a 90-day reprieve, and you're Steve Wynn somewhere, and you've just pulled a massive capital expenditure plan. You're no longer going to be updating the Encore Tower suites. That's gone. But that was, that was so last week. Today we have a 90-day reprieve. So I'm going to put all those plans back on the drawing board immediately. Is that how you're thinking? Or are you thinking to yourself, I don't know that that's necessarily, I don't know that 90 days is enough for me to put back on the table something that took me years of planning to put on the table, that last week I decided, you know what? Things are so crazy. We're just going to put that on ice for now. We're going to shore up our cash position. So you're Steve Wynn right now, Adam. Are you bringing back to life that $600 million capital expenditure?
Yeah, no, I think it's a great question. I think it's totally understandable to your point that CEOs kind of have Charlie Brown's skepticism about the football that Lucy's put back up on the tee, right? If I start running for this again, are the tariffs all of a sudden going to go back up to 145%? So no, it's challenging. Okay, so let me
and I'm not look, I'm not trying to be the ultimate skeptic here at all. It's
at
just,
all. Yeah.
we've seen business outlooks in the soft survey data vacillate. What we haven't seen, which is new, are capital expenditure intentions.
Right.
Follow business outlooks right off a cliff. And those are long-term capital spending plans, and it's rare to see them fall off across the country in sync with one another. I just don't know what's going to bring that back, because you have to bring that back to bring back hiring at the margin. And we need hiring at the margin if we're not going to throw $20 trillion of federal stimulus out there when we can extend tax cuts.
And we need private hiring at the margin, because for the past couple of years, it's been government, right? Which now is not pulling that weight anymore. All right, so I'm glad you brought this point up, because I've mentioned it once or twice recently, but I appreciate that you're putting it fully in the spotlight right now, which is, you and I have talked many times in the past, Danielle, about the lag effect of monetary policy, right? What you're kind of talking about here is the lag effect of corporate CAPEX spending, right? Which is, the longer that we remain in this chasm of uncertainty, where corporate budgets have basically tightened up because CEOs just don't know what's going to happen yet. So until I know, I'm putting things on ice. The longer that persists, then there will be a lag effect of, hey, this economic activity that would have gotten done didn't get done, and we're going to feel that. So the longer it persists, the bigger the lag effect's going to be whenever it arrives. So you're kind of nodding as I'm saying this, but let me let you comment on that in any way, shape, or form. But this is sort of another lag effect we should be paying attention to, right?
We should. And I mean, there is unequivocal good news in the reprieve on China taxes, right? We're not going to have mass layoffs and firings at the docks and in warehouses. They're not going to fire the people they planned on firing.
Right. Small businesses can now still get their product. The things will still move in a way that folks were afraid about. Yeah.
And that's fantastic. And right now we have saved Christmas. If you look at the timeline and you look at the lags and what have you, and get the tankers on the water, et cetera, et cetera. So we've avoided a massive negative shock in transportation and warehousing. That's a good thing, because transportation and warehousing created 50,000 jobs in the first 3 months of 2025. I mean, not near as much as the 192,500 jobs that were created in healthcare and social assistance, which is still carrying most of the load. But again, the 50,000 that were hired in the first 3 months of 2025, at least we know they're not going to be fired immediately, because there's going to be yet another wave of front loading. But this being said, you asked me about long-term planning, and it's long-term planning that has to be put back into place in order for the CEOs and the CFOs to take the next step and stop cutting costs and start adding expenses and start hiring people. And I actually happened to find Treasury Secretary Scott Bessent to be a brilliant individual, but you can only play the hand that you're dealt. And right now, he's been dealt a hand that says in the next 90 days, you need to figure something out with China. Not how are you going to figure out how to open factories as soon as possible. He's negotiating. And the longer we negotiate, the longer we dither. Um, President Trump says all the time, we've got $7 trillion of committed capital. That's great, but they have to be built. And the facilities that are being built have to understand what their operational framework is going to be and with whom they're going to be dealing, suppliers. So I want for this to work because my greatest fear is that we have a pendulum swing back in the midterms and then we have a lame duck White House and nothing gets done until the next election. And then it swings all the way to the other direction with universal basic income and modern monetary theory. And we don't want to work. And it's all the baby boomers' fault. And we're entitled. And for God's sake, just let us live in peace and pay for us to do so. I don't want the pendulum to swing that far back at all. I love capitalism and I love democracy. But my concern is that there just won't be enough time, especially when the only thing Congress has done is prevent the government from shutting down. We haven't seen any legislation of any kind.
So I was smiling as you were saying that because I literally, right before you said it, I wrote this down. So my takeaway from what you're saying so far is we've got this double barrel of economic challenge ahead of us. We've got the sins of the past catching up to us, and we've got the disruption of the present, right? So you said there's sort of both two things that are kind of pulling economic activity down. Then let's assume for a moment that the Trump administration's policies could be implemented, will be implemented successfully, right?
Okay.
What I take from you is in the near term, like between now and the midterms, it's immaterial. There's just not enough time. We've got that double barrel impact and plus not enough time equals basically a rough patch for the US economy some point between now and the midterms.
Well, I think that that's what's going to happen. And the only thing that raises my conviction is that the powers that be in the data agencies, they're under attack by the current administration. They withheld, to the point of statistical anomaly, they've withheld harsh data to try and gloss over the sins of the past to the extent that they possibly could. And the more the negativity continues to be withheld, the more they're going to keep the Fed on pause. And the greater the chances that the Fed's going to be too high for too long, and the greater the risk, in my mind at least, because I don't see statisticians waking up the day after the election and saying, okay, we've got a new guy in the White House, let's support him too, even though we're going to be under attack. So if you're shrewd and you're running one of these statistical agencies, and I've actually had a change of thinking about this, you don't just wait until it's no longer data with Joe Biden's name attached to it. You actually keep the Fed on ice for as long as you can. And then you get as close to the midterms as you possibly can to carpet bombing this man. Let it all loose. Just let it all out. The Fed will be like, oh, for the love of Mary, and we got to rush in with big rate. By then it will be too late. And that's my greater concern right now. And this is one of the reasons that I wrote my weekly quill that'll probably get me canceled on many different platforms, which I'm okay with. But the title was Powell Sinks to Trump's Level. There, I said it out loud. But my institutional clients have seen it. But right now, Powell appears to be playing politics and ignoring to a fault what Jan Hatzius at Goldman Sachs called out the Sunday before the Fed last met. And that is, a blind person could see the disconnect between the soft and the hard data, which has never been near as severe as it is today.
Okay. So I guess maybe a punchline there is you think Powell may be about to earn his new moniker from that Donald Trump's already calling him, which is too late Powell. And it's because he's playing politics or appears to be playing politics.
I hate for that to be the case. You know better than anybody else because we've been speaking all these years that I have been a proponent of Powell's. Uh, but there is no way in hell, given what so many Americans are going through, that he should have sat up there at the podium and said that the labor market is strong or the labor market is solid. That is just at some point it just becomes mean-spirited.
That chuckle is gallows humor, laughing. All right, so I do want to ask you some questions about the Fed, and you just opened a really interesting door that I want to ask you about in terms of your thoughts on Powell's successor when we get to that stage, but that's not for another year.
But it's happening sooner than you think, Adam. You should ask that question sooner.
Okay, well, I'm going to get to it. Let me just ask you this. So, not this, we're not taking sides here, but in general, we now have a pretty good sense of what the planned economic agenda of the new administration is, right? I mean, it's still TBD how they're able to affect it and implement it and all that stuff. But from a policy standpoint, what's your general take on the policy as a total package? Comparing it to, past couple of presidencies, or compared to the unsustainable issues that we could have discussed in October. How do you feel about this package of economic policies going forward on a net basis? Is it net some of the things you would decide to do if you were in power? Is it the wrong direction? What's your general sense?
Well, the risk right now is more to the growth outlook than it is to the inflation outlook. And that is because it is never it's never an easy job if you're in the position of leadership to conduct and to make policy amidst a global trade war.
Mm-hmm.
And that simply is where we are. It is why global trade contracted for the full year of 2019. So trying to extract benefits in this environment is extremely difficult. We have a huge victory with China this morning, but boy, Europe looks even worse. I mean, no impulse control in the White House is also highly problematic.
Mm-hmm.
But when I say that we need certainty, knowing what a tall order that is, we need certainty consistently geographically as well. And I think that is part of the greatest challenge here. Again, from 2018 to 2019, the CPI year over year declined. And the offset to global growth was greater than any
inflationary output. Yeah.
Yes.
So, okay. And I think this, again, probably makes you even more confident that,
Powell's committing a huge policy error.
okay. So Powell's committing a huge policy error. The current disruption of the administration probably creating a near-term, economic malaise. But so let me ask this one more time. So it sounds like you would say, hey, you would be conducting the trade part differently than the current administration is. And this is just one policy of the overall economic package. But do you think renegotiating America's trade deals, is that something that you would do, comparing the pre-2025 America to now?
Yes.
Would you do the same thing with deregulation, tax cuts, et cetera, or would you have a different platform?
So deregulation's something of a no-brainer, as long as it's deregulation that is applied differently, because deregulation, the way it's been rolled out for several generations, has only served the largest players.
Mm-hmm.
So we don't want to further concentrate the power in the hands of a few.
Give the entrenched cartel even more benefits, yeah.
Exactly. So deregulation, I'm all over, but it cannot be deregulation just for the biggest lobbyists. And that's how it's worked out, regardless of who's been in the White House for generations now, or we wouldn't be in the situation that we're in right now. But in its truest sense, I'm all over capitalism, competition, et cetera. As far as the trade policy goes, If there's any assumption at all that the United States, in the event that you are attacked militarily, is going to spend money making sure that you don't get roasted, then there should be a strict zero tariff policy in your country. Now, if there's no assurance that the United States is going to take care of you, then you can set your tariff policy how you want. Do what you wish. But if in any way, shape, or form your sovereignty depends on US military support, by golly, you better not have any tariffs on us at all.
All right, I could see some people cheering that. And of course, if you're not, if you're one of those ones that don't depend on us and you can set your tariffs any way you want, probably fine, but we're going to set our tariff policy accordingly to your country, right?
We are, and you can go ask Xi Jinping for money if you get attacked. Go for it.
Yeah. Okay. All right. So I'm going to take that and correct me if you want to, but that you're generally more on board with the current the current administration's economic policies than say the past several administrations minus Trump 1.0, because he's trying to sort of continue that here. I guess I'm trying to.
I do, but I don't think they're focused on what I just described.
Yes. Okay. So
I think they're focused on China, and then they just folded on China. So again, I don't understand what's going on, but shoring up our allies first and foremost while keeping punitive tariffs on China, that would have been my blueprint. We're not going that direction.
We're not. Yeah. And I'm probably doing an unsuccessful job of trying to separate the goal of the policy versus the approach that's being taken. Right.
Yes.
Okay. So, given that we know what the policies are, Trump is, well, let me put it this way, he's making Powell out to be a villain here. I think you think maybe, there's some valid criticism for that. But it sounds like, and you correct me if I'm wrong, it may be useful for Trump here to kind of have a villain to take some of the blame here in the near term, right? So that if we do indeed get in this rough patch, Trump can be saying, look, I've been telling this guy to cut, for quarters now, and he's been ignoring me. And if you're angry at what's going on, hey, look at this guy instead, right? So there's some advantage. I mean, I know it'd be really hard for him to get rid of Powell anyways, but there's probably some advantages to have Powell be in opposition to him here to a certain extent, because he can redirect anger towards Powell. Not that too many people care about who the Fed chair is, in terms of the average working class American, but it does give him kind of a convenient villain to point to. And then secondly, and you're sort of nodding as I'm saying that, and secondly, Powell's term is going to be up in about a year. So what should we expect from the successor? And you said there's already progress being made. So are there some front runners emerging? I've heard some people say Kevin Warsh looks like the right guy. You might have somebody else. But do you expect that the next person to come in to try to really maintain Fed independence as well? Or is this going to be more like a Trump buddy who's going to really kind of march in lockstep with the administration?
Well, the answer is I don't know at all because of what Michael Barr did. And what
Many
Michael
people
Barr,
might not know that, so elaborate.
so Michael Barr, after being crucified on the editorial page of the Wall Street Journal, and after every banking and non-banking lobbyist on planet Earth, first order of business was get rid of Michael Barr, get rid of any chance of regulating the shadow banks. So that was taken care of very, very quickly. He was removed from his position, or he retired, he resigned from his position of banking, vice chair of banking supervision and regulation, and ... chose to continue his term on the Board of Governors. Meaning, in May of 2026, Jerome Hayden Powell, his 4-year term ends, and he can choose to remain on the Federal Reserve Board, finishing out his term as a governor, if he chooses to do so. Meaning the only person who's losing their position whose 14-year term is ending, is that of Adriana Kugler in January of 2026. So, in the event that Powell is playing politics, and it appears that he is, which is very distressing to me, but in the event that Powell's playing politics, then the only person who President Trump's going to have to choose from for his chair will have to be a sitting governor.
Mm,
So if he wants for it to be Warsh, he'd better replace Kugler with Warsh. And then come May, he can only choose from sitting governors if there's no open seat on
interesting.
governors.
Okay. And so Kugler, her term ends in January, you said?
January.
Okay. So that's when we should have a really good sense then of who Trump's pick is, because it's basically whoever's going to put to fill that position.
Pretty much. And that person would presumably be confirmed to their position and treated as Fed chair going forward, whether or not nominally they are or not.
Right. Right.
Because you're talking about February, March,
Yeah.
April by Powell. But if it comes down to a situation, and the Trump administration will know, even though Trump and Powell clearly don't speak to one another, but they'll know at some point before May if Powell plans on leaving the Federal Reserve Board or if he plans to serve out his term as governor.
Okay. And so I had an interview last week with Axel Merck right after we did sort of a live reaction to the federal open market committee release and Jerome Powell's press conference. And so Axel got to talk a bit about sort of Warsh as a person, but I'm just curious, do you think he's the likely nominee, or would you put your money on a different horse?
I actually do think that Warsh is the likely nominee, and I'm not so sure that Trump has a good understanding for the fact that Warsh is not a real big proponent of quantitative easing.
Hmm.
So there might be some homework in order.
Okay. Um, and I'm just curious,
I mean,
what do you think
watch
of?
what you ask for. Watch who you nominate.
Well, yeah, yeah. Now, that being said, Trump might have some buyer's remorse, right? If Warsh turns out to be, have some philosophical differences with what the president ultimately would like.
Maybe
But
he
I'm
chooses
just,
Waller. Waller's there.
yeah. But if you were making the choice, how does Warsh measure up, and is there somebody else you'd like to see even more in there?
So the only thing that bothered me about Warsh's recent speech was how little he said. So it sounded fancy, and there were a lot of big words
Hmm.
employed. I mean, you've read Fed Up, you know how I feel about big
And
words.
Fed speak, yeah.
Um, I would like for there to be a more pointed question and answer session. Um, you know, former Governor Warsh, let's just say theoretically, your former colleague Powell chooses to stop at 2% if prompted to lower interest rates. Do you agree that the zero bound should never be revisited? Oh, great. If you agree that the zero bound should never be revisited because prior writings on your part suggested that the zero bound was broken, would you therefore agree then that quantitative easing is never coming back? And are you sure that the president's okay with this? I just had three questions.
Okay. All right. Well, we got some time between now and then, so we'll see if he gets up to the mic again, and if he does, we'll see what he has to say. But it sounds like at least I don't hear from you saying, "Oh my God, that would be a terrible pick."
If he sticks to his mind frame that he had uh, when he was spilling ink and criticizing quantitative easing and the Fed being in a credit easing position and the inefficacy of the zero bound, I'll be barking like a seal. Go Warsh.
Okay.
If he flips, well, not so much.
All right. Okay. All right. Well, I got to start landing the plane here, unfortunately. So two last sort of major questions for you. One is, we talked about your concerns here that there's just not enough time between now and the midterms to try to avoid this double barrel of economic headwinds, we'll say. Um, so if indeed that means the economy is slowing and danger of it tipping into recession, from what you can see so far, how bad of a downturn do you expect? And just describe it in sort of the everyday man's lived experience. Is this you mentioned that we're already kind of at 100,000 layoffs a month, but I mean, do we really start seeing huge net job losses? What does the unemployment rate spike to? Is it going to feel, you know, like one of the bad recessions we had in the early 90s or the 80s or whatever?
So it's a really difficult question to answer because the media and the nation's statisticians have kind of been gaslighting the American public for as long as they have.
Yeah.
But what we do know, however, is that the slightest hiccup in the stock market was sufficient to have people starting to cancel transactions to purchase homes. Um, we've seen bankruptcies spike already. My concern is that the starting point is the highest level since 2010. The media, if the media gets on board with the idea that there's a recession, my greatest fear is that it could become more self-fulfilling prophecy because so many Americans have been feeling recession for a
Right.
very long time now. But if the media all of a sudden jumps on board and agrees with them, then my greatest fear is that we'll entrench too much, that there will be too much of a pulling back. Because there's an underappreciation for how fragile the economy was to begin with. And again, that's because the media has been lying to the public for as long as it has. And I don't say that lightly, but that's been the case.
All
So
right. Yep. We get this sort of, self-fulfilling vicious cycle if the media really stokes.
and that is my concern. That is my concern. And again, the other one would be that of demographics. So again, if the media begins to make a big kerfuffle, big huge deal, it's the Trump recession, blah blah blah. If you could set off a daisy chain of events that then was to bring the baby boomers and the 40% of the stock market that they own into play here, where you could end up having kind of an adverse feedback loop feed off of itself based on the scare tactics that are running around in the media, making people even more restrained in their spending than they would be otherwise, sell more of their stock portfolio than they would otherwise.
Okay. All right. I'm gonna try to see if I can squeeze in one question related to that at the very end here. But just to make sure I ask this question. So, given that outlook, um, we're here now in May 2025. Um, what's your general outlook for the financial markets? I'm presuming, you're probably not saying, hey, they're your probably general outlook isn't super rosy looking at a nation that's potentially going into recession. I don't hear you say, but we're heading into it tomorrow, so sell everything today. But what for the next quarter or two, what do you see for the markets, and what type of strategy do you think will best serve today's regular investors?
Well, I think for you to say, oh, gee, look, the riskiest stocks are back in vogue in just the last few weeks, and therefore I shouldn't be defensively postured. No, I don't think that's the case. Uh, I think you stay defensively postured. You maintain your exposure um, to companies that are going to continue to have cash flow no matter what happens. So it might not be as sexy as trading in and out of Nvidia every day, but keep your
Mhm.
dividend paying stocks. And to the extent that the Fed remains reticent to lower interest rates, maintain your dry powder as well. You're
Okay, and it's
still
funny,
collecting plenty
maintain.
on it.
Pardon me?
You're still collecting plenty of income on it. So
Right.
collect the
Yep.
income, but don't give up your dividend paying stocks. Don't remove your defensive posture simply because animal spirits are where they are. But pay very close attention to demographics. Pay very, very close attention to the media because it's the media, I think, that can be a change agent, whereas the media has been uh, a calming agent. I think now the media can move to the opposite end of the spectrum and attempt to be a chaotic change element scaring people such that you have to pay attention to what the media is saying, which is a stupid thing to say, but the narrative matters. And if they're going to try and truly destroy Trump, and the media could, just bear in mind that that will have an effect on demographics and an effect on the 70-year-olds who own 40% of the stock market. You have to be cognizant of where the media is.
Okay, and you just mentioned something I want to clarify, which is you said you're concerned, you have a concern that the media could really start fanning the flames of concern around recession, then it becomes a self-fulfilling prophecy, or it makes it worse. Um, Sounds like you're saying that that could be a deliberate act, sort of a weaponization of sentiment against the president, because I mean we all know that in general the media establishment and Trump have a very contentious relationship.
Right. And they could use that contentious relationship and the fact that there is no love lost and use the headlines as weapons.
Okay. All right. All right. Well, look, Danielle, it's fantastic as usual. I'm going to try to squeeze in this last question, and then we'll get to let people know where they can follow you and your work. Um, so you talked about the importance of demographics, right? You and I are great fans of the great Lacey Hunt, who always says demographics is destiny, or demographics are destiny. Um, so I've asked this question of another mutual friend of ours around the housing market, and that's Ivy Zellman. But writ large for the economy, demographically, we know we have a wave of aging boomers, right? That in the next, well, over the next 20 years, there's going to be an increasing liquidation, rolling thunder amongst this population as they age and age out, basically, right? That they're forced to finally downsize their homes, move into nursing homes. Sadly, many will eventually pass away. Well, all will eventually pass away at some point in time. So, you'll just have this sort of relentless wave of selling financial assets, houses, et cetera. And oftentimes, especially in houses, to whom? To people who can't afford to buy homes at their current valuations, right? So there's going to be selling, and then there's going to be selling at lower prices, not because you want to, but you just have to, right? It's a life event, that's demographics that are forcing that decision. One can make the argument, wow, that's going to be like a kind of a dark, long winter for assets. Um, is that the right way to be looking at it? Is there a better way, a more accurate way to be looking at it? Is that a true worry? Is it a red herring? What are your thoughts on that?
So I think that that long dark winter that you describe is especially going to be the case in the second home market. And that is relevant because we've had so many younger Americans buy vacation properties. So in that sense, there will be this kind of relentless wave. I think for the broader non-vacation home market, that we will see a continuation of it. If it was 17% of home transactions in 2024 were to multi-generational households, I would venture to say that that'll be 20% in 2025. I think that we will see a continued bunking up, a continued adult children moving in with their retiree parents, or retired parents moving in with their adult children. I think that that trend is going to act as a mitigating factor going forward. And to the extent that that is not feasible, gee, I don't like my kids, gee, I don't like my parents,
Hmm.
um, then you will see life-changing moments, because the odds that one generation can afford that McMansion that the older people are selling are very low. So there's a huge mismatch there. But I do think that we see, as a large mitigating factor in housing, this continued multi-generational household formation. But
Sure, but you can kind of look at that as like family unit belt tightening, right?
oh, absolutely. And that's
Yeah,
not the US economy, because this is not, for everything there's a season. Nothing in Ecclesiastic says, and then you grow, and then you never leave home, and you stay with your parents, and you have children in your parents' home. That's not in the Bible. That's not how it's supposed to go. So, in that sense, you don't get the same torque that you would otherwise, of new people coming up and having 3.5 children and needing their own home. You don't get the same economic refresh and reset that you would otherwise. I just think it could be a mitigating factor for the individuals sitting in McMansions that are not fully occupied.
Fully occupied, right? Yeah. And again, folks, I want to really specify what Danielle and I are sort of speculating about here. Yeah, we're talking the next 20 years. We're not talking next quarter or next year.
Right.
But it is interesting to think about. Let me ask you one last question about this. So, you hear a lot of people say everything's going to be great. The boomers are the wealthiest generation, and they're going to pass all that down to their, kids. And so you'll just have a bunch of rich millennials, right, taking over, right? Let me ask you this. So, one, I'm skeptical for two reasons. One is, a lot of that wealth is priced at the margin, right? All homes are priced at the margin. All stocks are priced at the margin, right? So, if you end up selling that McMansion for what a millennial can buy it for, well, you might find that price is 25% lower than what it is today, right? So I don't have the number off the top of my head. For some reason, my head wants to say like 70 trillion of assets are owned by the boomers or something. But whatever the number is, okay, well, haircut that by 25% maybe, right? And then, that's an average number, meaning if you look at the median distribution, it's quite different, right? The average is skewed high by the super wealthy households. I think there's a lot of that boomer wealth that's there, but I'm not sure if it's going to actually survive the boomer's lifetime,
Well,
right?
no, and you get to actually, by very, very callous, every time somebody talks to me about the greatest wealth transfer of all time, I'm like, well, sure, and let's make that happen. Go kill mom and dad now.
You know?
Otherwise, they're going to outlive their wealth because life expectancy is what it is because they want to age at home.
Right. Well, and the cost of life expectancy is a
Is
lot
enormous.
more than what it used to be in previous generations, right? I mean, almost the system is designed to kind of bleed you of every dollar you have in your last years of life.
I mean, I don't, I'm not serious. I mean, I am Italian, but I'm not crazy. I don't mean you have to kill your parents, but I watch so many of my friends. I'm extremely blessed that my mother's on a government pension and that we happen to own the home she lives in and that she's fine. But I'm watching so many of my friends struggle to pay the cost of whatever it may be, assisted living, nursing homes for their parents. I'm already watching it. And it just, COVID eviscerated the ranks of individuals working in the lowest paying jobs at nursing homes and home healthcare workers. And so the cost of aging is so prohibitively high, so much higher than it was even than 5 years ago, that there will be an enormous amount of wealth that is passed down. But it's not going to be the case if under the current healthcare construct.
Okay. So, and first off, I'm glad to hear about your mother. But my mother passed away a couple of years ago, as I think my viewers, longtime viewers know. And she didn't have a lot of assets, but she definitely outlived them. And I can just say, you don't want to, if you can avoid outliving your asset, folks, do it because life's not so fun once you've done that. Um, okay, so what I'm kind of taking from this, Danielle, maybe this will be a really interesting conversation to dive more deeply into in a future when I give you a fair amount of time to really do this topic justice. But it sounds like kind of like me, you've got some concerns that yeah, there might be a really long economic winter where we're not getting that torque, as you're saying, in the economy because we have this just long rolling thunder demographically, and even this big pile of boomer wealth. The expected value of that might be an awful lot lower than what people are imagining right now for the reasons that we just talked about. Okay, so we'll leave it at that. More TBD. Thank you for entertaining that part of the discussion with me. Let's end on something really positive, which is, Danielle, for folks that have really enjoyed this interview and would like to follow you and your work between now and your next appearance on this channel, where should they go?
So if you don't already follow me at DiMartino Booth, please do. And love to have you come and become part of the Daily Feather community. Coming up on my 10-year anniversary of having retired from the Fed, so we're going to be running some 10-year promotions, unlike which we've ever run before, even for our institutional offering. So please follow me on Twitter and come to QI Research and see what these promotions are going to be all about. We have a cult following, people who wake up every single day and read their feather first, couldn't be any prouder to be able to say that. So love to have you become part of that community.
Well, extremely well deserved. Danielle, when I edit this, I will put up links to your Daily Feather website as well as your Twitter so folks can follow you. And folks, they absolutely should follow Danielle if you don't already. Danielle, I'm super thankful that you did take that jump 10 years ago to go do what you do. You're a very important grounding and informative voice out here in the wilderness. So thank you. Um, uh, just as we wrap up here, I'll let you have the last word. Most of the viewers here are like a lot of, the retail readers of your Daily Feather, Danielle. They're just regular people who have worked hard to build wealth, to provide a good financial future for their families. And they're looking at a lot of the same things that you are and are concerned. And mostly they just don't want to become collateral damage to these forces. So what bits of parting counsel would you have for them?
So my parting counsel would be that I speak to more and more individuals in my personal life who have decided to go this multi-generational route, or they're not telling their adult children that they're burdens because they've graduated, and they're instead inviting them back into their house. They're willingly doing so to say, hey, I want you to make sure you have a nest egg so that you don't go off until you are able to do so without taking debt on.
Right.
So, you know, maybe I'm showing my age, Adam. I don't know, but embrace your family and embrace your neighbors at times like these, because we don't all have to start off our adult lives in debt. And to the extent that you can prevent that, to the extent that you've got, why is that bedroom and bathroom unoccupied? Help your adult children if you haven't, by giving them the chance to save up the nest egg. They don't exactly have, the VA plan to come home to like my parents did. So, but try and think in terms of the next generation and their financial freedom if you're financially free yourself.
Great point, Danielle. I actually would love to reserve some time next time we talk to really delve into this as well, because I feel really strongly about it. Um, Culturally, there's I mean, most cultures actually do this, right? And America used to do it until relatively recently. And if you look at successful, immigrants to America, this is kind of the model, right? You come here, bring your kids over, everybody lives together until the kids have saved up enough to be financially resilient, and then they go off and they'll kind of daisy chains from there, right? Now you don't want to be an enabler, and if you're the younger generation that is working with your parents this way, you got to earn it, right? It's not a handout. But there's a lot of economic benefits that we would get from a society from this, but I think there's also a lot of just cultural and value-based benefits that we would as well. And again, it's sort of the way the world used to work for how families used to work for a long period of time. So there is a lot of benefit to going to it. I know it would have been really hard for me if I had, I mean, sometimes just the dynamic with the parents, can be really hard, but that means everybody just has to work better at learning how to get together. So anyways, it's a very important point, one that deserves more than just the minute and a half I gave you here, but I appreciate you bringing it up.
And thank you for asking me, Adam.
All right, so in wrapping up here, folks, please let Danielle know how much you appreciate her coming on and sharing her outlook with us by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. Also, if her outlook for the markets here have gotten you a bit concerned about how your financial portfolio might be positioned and maybe more vulnerable than you'd like to this potential rocky road that she sees ahead, highly recommend most people watching this video seek the counsel of a good professional financial advisor, one that can not just put together a plan for helping you navigate the potentiality of that type of future, but also can help execute it for you. If you've already got a good financial advisor who's meeting those needs, great, stick with them. But if you don't, or would even just like a second opinion from one of the ones that you see with me on this channel week in and week out, feel free to schedule a free personal consultation with them by filling out the short form at thoughtfulmoney.com. Only takes you a couple seconds to fill out the form. These consultations you get are totally free. They will just sit down, hear your personal situation, give you their bespoke advice on what they think you should be considering doing. And there's no commitment to work with them involved. It's just a service that they offer. Danielle, can't thank you enough. It is always wonderful to have you here on the program. Thanks so much for sharing your time with us today.
And thank you for having me again.
All right, and everybody else, thanks so much for watching.